The financial landscape in the US is still a little bit rocky, but stay tuned to the end of this video so I can show you exactly what I'm doing to kind of protect myself in this landscape. So what we have right now is the FDIC has found more problem banks, which are now at a 3-year high. They said the overall number of those banks is 68 as of the end of the third quarter, this last year, which is up 2 banks from the second quarter, is at a multi-year high. Welcome to the AlterNate Vantage. My name is Nate. This is where I provide a different perspective on finances, news, and generational wealth. If you like this kind of content, don't forget to like and subscribe. And with that, we'll go back to the video. So first, let's define what a problem bank is based on their own words. So they say problem banks are those institutions with financial, operational, or managerial weaknesses that threaten their continued financial viability. Essentially to say they're insolvent. They spent too much money than they owe, and now the depositors want that money back, which is creating problems. Total assets held by problem banks rose $3.9 billion to $87.3 billion in the third quarter. Problem banks represent 1.5% of total banks, which the report said is within the normal range of 1% to 2% of all banks during non-crisis periods. Okay, so is this grounds for you to freak out? Should you be worried about this? Is your money at risk? For the large part, for the most part, no, not necessarily, but I think it's still important for people to understand what happens when you place money in a financial institution like a bank. First and foremost, when you put money on deposit in a bank, you are considered an unsecured creditor. Legally speaking, that's the term they use. So that means you have credited the bank with no hopes of any form of collateral. You are unsecured. You have simply provided the bank your dollars, and the bank now becomes a debtor to you. They owe you your money back at effectively no risk because, once again, you're unsecured. So the bank's going to go and do things like invest that capital. They're going to put it to good use. Hopefully, they're going to recapitalize it. They're going to loan it out to other people in hopes that they can make more money, and they hope they can make that money by the time that you claw back that capital, spend it, send it somewhere else, whatever the case may be. But that's the overall process. And that's what happens, typically speaking, when we have these banks that are going towards insolvency. It means they have spent too much money than they owe back to their depositors. It happens quite frequently because that's kind of how our banking system works. The banks are notorious for hypothecating the capital, which essentially means they use the same dollar 10 times in hopes that that dollar isn't clawed back in the near future before they can get back the money that they owed out or lent out 10 times. It's a deep process. I'm not going to get into the specifics here, but this is how banks lose their capital, and this is what puts depositors at risk, but that risk is backed up by the FDIC, which says that they'll insure depositors up to a certain amount. Now, obviously, if you are over this FDIC insurance threshold, the wise thing for you to do would be to split up your accounts into a multitude of banks or a multitude of sub-accounts so that way you don't go over the FDIC insurance threshold. That's the first thing you can do. However, what I would say is even better than that, and especially if you're thinking long-term, would be to put some of that capital and to place it into something like whole life insurance, which is a cash flow vehicle. The reason why I say this is because oftentimes banks will bank at whole life insurance, meaning they place money into policies which they then use to bank off of for the depositors. It's a very safe place to put your money because insurance companies can't hypothecate the dollar. If $1 is in an insurance policy, then that dollar has to exist. It's not like they put $1 in and the insurance then uses it 10 times its actual value, putting them at higher risk. That's not the case. Insurance companies are very, very, very well and secure. And generally speaking, over the last 100 years, they've had very good performance as opposed to the banking industry, as opposed to any industry, as a matter of fact. For the last 100 years, they've been consistently paying out dividends, which is very important because we had things like, the Great Depression, or the hyperinflation of the 70s, or the dot-com bubble, or the Great Financial Crisis. During these times, insurance companies, especially whole life insurance companies, have been paying out dividends. Now, have these insurance companies gone under? Have they collapsed? Absolutely. But in comparison to banks, it's like a fraction of a fraction of a fraction. You're talking about onesies and twosies in the insurance realm as opposed to hundreds and thousands in the banking realm, which is why I find that I have a lot of security when it comes to whole life insurance policies. And I'm going to go into other videos in the future, the complete strategy when it comes to whole life insurance policies. This isn't like a WLI, infinite cash flow system type channel. This is really just kind of delivering the tools to the people so they can understand how to use them, when to use them, and why to use them. But this is what's going on in the banking industry. I thought it was important for today because I don't think we're out of the water yet. I think we're still going to witness more banks collapsing. We're going to witness a consolidation of banks and depositors to a select few of banks. I think those are going to be like JP Morgan, Wells Fargo, Bank of America, and Citibank are the four that I think are going to be left standing at the end of the day in terms of like the biggest banks of the banks of the banks. It's like the reserve banks of the reserve banks kind of deal. I think that's the direction we're heading. And ultimately speaking, if you want the most flexibility in your capital with access to that value for the future, for when these things do take place, then whole life insurance is just an excellent tool to have in your belt when the time comes needed. So thank you for watching this video to the end. If you like this kind of content, don't forget to like and subscribe. And with that, I will catch you in the next one.